Hi, folks. Welcome. And David, thanks for having me as usual. Um, my name is Dan Passarelli, and I've been in the options industry for 30 years. Yeah, been a long time. I'm the author of two books, Trading Option Greeks and The Market Taker's Edge. And I am the founder and CEO of Market Taker Mentoring, which is the global leader in option trader education. And I'm really glad to be here. So that being said, what can we look at today, folks? Looks like you're putting questions and such in the questions box, yeah? So go ahead and, or the chat box, I guess it looks like. What do you want to look at? S. Oh, you already got symbols in here. Holy cow. All right, Daniel's first. NMIH. Bring this over here so it doesn't look like I'm looking across the room here. NMIH. Okay, so this is NMI Holdings. Now, this is a stock that I don't look at very often. So, what do I do when I come across a stock that I don't look at very often? Well, this is what I do. I go here and I go to bookmarks and I go to Barron's and I type in NMIH. Now, why am I doing this? Aren't we supposed to be looking at the charts? Yes, but I need to get some context. I need to know what kind of company this is. That's going to guide a little bit of my technical analysis. NMI Holdings engages in the provisions of private mortgage guarantee insurance. It focuses on long-term customer relationships. This blah, 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 blah. Okay, so mortgage insurance. So that is an interesting company here. Now we look and there's not a lot of short interest, which is one of the things that sort of jumped out at me in a situation where there's a lot of quickly fluctuating interest rate environments. That can be a little bit trickier for mortgage lenders and therefore creates greater systemic risk for mortgage insurers. But we don't have a whole bunch of short interest. What I do notice is that the PE ratio is 8.84%. Now, holy cow. Or not percent, $8.84. It's 8.84, sorry. So that is pretty interesting because that's a pretty darn low PE ratio. Analyst ratings is to overweight. Let's take a look at this. Daniel, I'm glad you brought this up, my man. So from a pure technical standpoint, and I was just putting together a presentation on time spreads. So I removed a couple of things from this that I typically have on here. One being RSI. And I just go with the out of the box 1470.30. Now, if you've been watching the market, and I think you have been, because I'm not the first person you're seeing here today, this is a chart shape that you're probably familiar with. There's a whole bunch of charts that kind of have a pretty similar shape to this. Notable difference is if we go to SPY, we're below the 50-day moving average. Apple, we just crossed the 50-day moving average. NMIH didn't make it below the 50-day moving average this time around. It hasn't been below that since way, way, way over here. So this becomes an interesting stock. Looking at the first level of support, 34.42. Well, actually, the first level of support is the 50-day moving average, which is 35.33. Then we've got more support at about 34-ish, a little bit more at about 33.5-ish. There's a great deal of support. Now, this is the 21-day moving average, which, unlike other moving averages, I don't really look at as support and resistance. I look at that as a breakout or breakdown, basically a follow-through type line, a momentum line. If we break through that, we tend to get momentum. And you can kind of see there have not always on this chart in the past, did we? But a lot of the times when we decisively broke through, like this, we traded along with it. Here we broke through and it stayed under for a bit. Here it broke through, it took off to the upside. It was a short kind of false signal, but here you had a good couple of weeks. Here you had a good couple of months. So looking at this, I'm not ready to jump in fully bullish, especially in a market like this. I'm not sure what the professor said last time I just jumped in as he was ending. But I see this market as being volatile going forward, which is pretty obvious if you look at the VIX. I mean, the VIX is still up at 1879. People are buying options nervously. So I'm not ready to jump in here with a very aggressive bullish stance. Obviously, even if I did, I would use a stop loss. But what I'm a little bit more interested here is a put credit spread type scenario if the volatilities line up. So where would I set my short strike if the volatilities line up? Well, certainly 35 would be a nice level. But if I could get it down to about 34.5, I'd be thrilled. Now, I don't know. That's pretty far away from the money percentage-wise, but let's take a look. What did I say? 35. 35? Yeah, 35. Yeah, it gets a little tricky with these stocks that are under 50 bucks to look at credit spreads. I mean, I don't even really have to look at the volatility. I mean, it doesn't do me any good looking at the volatility, especially since the options markets are so darn wide here. I mean, gosh, Daniel, I mean, there's nothing I'm an options guy. I mean, you can't trade options on this. The markets are just too wide. You're guaranteed to lose money. So, sorry, my friend. On to the next one. All right, who we got here? BJ, right? SOXL. So this is the semiconductor bull 3X ETF. BJ, you're freaking crazy, man. You need 3X on semiconductors? Holy crap, man. I like your spunk, though. I'll tell you that, baby. I like it. Are you wearing a cowboy hat right now? Tell the truth. Are you wearing a cowboy hat right now? I want to know. I bet you are. I'll bet BJ is wearing a cowboy hat. Please send a picture. David, are we able to post pictures here? I don't know. I'm just guessing, but I'm pretty intuitive. All right. So anyway, semiconductors have been pretty freaking weird lately, right? And I just want to look at some of the ones here. NVDA, which is just the darling. You chill out, Peter. No, I'm just kidding. I'm a little excited today, okay? I've had a lot of coffee. You can't chill out unless you have iced coffee. All right. So anyway, NVDA, we've got we came down from a high of over 140 down to a low of 90.69. Oh my gosh. Are you kidding me? That's like that's a pretty darn big move down. That's like 38% or something. Now we're back notably above the 21-day moving average. Now, a stock like NVDA I'm just going to tell you that really trades very, very technically, especially since the split happened, was that a couple of months ago? It's, it was up in the 800, which is, that's $80,000 for 100 shares. Now we're talking like, pop off 10 grand on 100 shares. This is very accessible for a lot of traders. And it just moves around so much that we've got a lot of retail traders getting in and out of this based on technicals. Now, NVDA, here's what we have to do. I'm going to show you a little trick here. In addition to this, we want to see the components. Market Watch will break those down for us. So NVIDIA is only 6.33%. Okay. So it's not really super overweighted. Cash manager, but it is, I mean, Broadcom, NVIDIA, and AMD are the top holdings. Okay. Well, that is definitely good that it's a pretty balanced weighting. Okay. So another one that I want to show you though, and I want to see how much this one is in there. SMCI, View Holdings. Come on, baby. Yeah, well, let me get in there. But I mean, we're still down below anything below KLA. It's less than 3% anyway. So pretty diversified, but all within the semiconductors, which, the semiconductors it's a more disparate business than you think. Like this is the picture of NVIDIA. If we look at SMCI, it's a little bit of a different picture. This one's down. I mean, it had a decline of almost 60%. Okay, so back to the original question. SOXL. The key here is going to be the volatility of it. All right. And because this is 3x, I mean, it's going to freaking move, man. I mean, not even a month ago, it was at 70 and it lost 70% of its value. Now it's only down 50% from its high now. So to me, I personally don't feel the need to do a lot of these 3x ETFs from a directional standpoint. I would rather do options to get that leverage and still be able to limit my risk. But that's a directional standpoint. What I care about here, and this could be very interesting, is the volatility perspective. Now, if we were to go and look at the historical volatility, which is about 190, which is massively high, massively high. And it's very unlikely that the volatility in semiconductors is done. We can actually buy extremely underpriced volatility. My goodness. Who asked this question? BJ? You're going to be able to buy yourself a new cowboy hat if this one works out. If the historical volatility is 190 and the implied volatility of, say, the 38-day options is 108. These options are massively, absurdly underpriced. Wow. Now, like this is some consolidation relative to this. But with straddles, I always love to give myself more time. 38 days is about right. And I'm going to model this nice and small here because I know we've got some big traders here. I know we've got some small traders here. If I go create duplicate order, if I were to be able to buy these at say 975, 975 divided by 34.9, that's 28%. 28% in 30 days. Do you think, BJ, in your cowboy hat, that Soxel here can move 28% in 38 days? As Sarah Palin used to say, you betcha. I'm going to create, I already created duplicate order. Let's just test the waters here. Yeah, in case you didn't notice, I kind of like that trade. You are not going to come across massively underpriced volatility like this on a regular basis. Most straddles are extremely difficult to trade, and this one's going to be difficult too. I wouldn't be surprised if I take a little bit of heat on it. And I wouldn't be surprised if I have to eat a couple extra Tums more than usual. Maybe lose a night's sleep or two. But we would have to get, implied volatility would have to drop almost in half for this to not have edge on it. This is one of the best straddles that I have seen in at least a year. All right. Now, BJ, are you familiar with straddles? And while you're doing that, I'm going to move on to Daniel here. FN. Fabrinet. Now, I'm the kind of guy who sits around all days and looks at stocks. I look at stock charts. I look at stock option chains. I read about stocks. I look at financial statements. I'm just a big freaking nerd like that. I know a lot of stocks. Fabrinet, is it French? Oui, oui. I'm not familiar with that one either. So I'm going to go over here to my good friend, Barron's. I'm going to pull that up. Provision of optical packaging and electronic manufacturing services to original equipment manufacturers, firms, engineers, process design, failure analysis, sensors, optical. Okay. Fair enough. Not a lot of short interest. Although, you know, we had some profit taking on a lot of the shorts as well. Short interest is down 10%. It's probably a pretty regular PE ratio, regular to high. Is there anything, Daniel, is there anything in the news that we need to know before we focus purely on the chart? Don't hold out on me. Okay. So we've got the 200-day moving average, which is a very huge support and resistance level. Like maybe the most important support and resistance level. So we tested it, and this was in a pretty aggressive, sort of panicky sell-off. So, I'm not going to say, oh, it was below it and then it was above it. It tested it. This is not a significant technical situation. Now we're getting this bounce off some pretty good solid support. We filled this gap. And from a technical standpoint, this is pretty bullish. But there's going to be a lot of volatility in this market, probably for a little bit of time here. So we want to be very careful with it, especially after a run-up like this. Although the RSI does not show anything overpriced or anything, but we have to take into account how the RSI is calculated. We did have we've got some pretty downward moves in there as well. So this wasn't a pretty aggressive comeback. If we bust through the 21-day moving average, we could have some follow through. But here's the question. Who knows what I'm going to look at next? I bet you know, because I already mentioned the importance of it. Let's look at the bid-ask spreads. So I have a rule when it comes to bid-ask spreads. You know what that rule is? I don't like to see the offer more than 10% greater than the bid. Seems fair? Because if the markets are that wide, it's no bueno. Here we've got a $1.50 bid. 10% of that is 15 cents. So I don't want to see the offer more than $1.65. Well, what do you know? It's $2.60. This is $7.80. Round that to $8. 10% of that is 80 cents. I don't want to see the offer any more than $8.70, and it is. These markets are really, 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 really wide. Now, this is a chart reading sort of workshop here, a trade finding sort of workshop here, and I'm an options guy. Given this market scenario where the whole market is very likely to continue seeing up and down volatility for a bit, I'm not ready to pull the trigger aggressively on a directional trade here, especially when you see gaps like these too. Because sure, I can put in a stop order, but stop orders don't protect you from overnight gaps. Options do. This is why I trade options, because I like to be able to control my risk. But you can't trade the options because they're just not liquid enough. I mean, look at the open interest. That is just poopy. It's poopy. Terrible. So between the open interest and the bid-ask spreads and the volatility of the market lately, Barry, what's up, my friend? Says, sometimes I cannot take your spreads in your credit spread genius, no margin. Can I just buy, call, or put? Well, yeah. So Barry's relating to our genius programs. We have credit spread genius, we have time spread genius. I'm surprised I should not talk about time spreads, because this is an incredible incredible time for time spreads. There's a difference though. And, those of you who are enrolled in Credit Spread Genius or Time Spread Genius, we always have to do the analysis first. And for the credit spreads and for the time spreads, the volatility analysis is a very, very big and important part of that. So if it makes a good credit spread, that means implied volatility is high. If it makes a good time spread, that means the term structure of volatility is disparate favorably. Neither of those would make a good long call or long put. If it makes a terrible time spread or a terrible credit spread, that means volatility is cheap and underpriced, and it would make a good long call or put. So yeah, and let's talk more about this. Now, Barry here, he's in our Genius program, sounds like, and more advanced, I think. So I'm going to break this down a little bit. I don't see a request to look at anything just yet. So I have, let me see something. Yeah. Well, this is an interesting one. So this is our time spread genius. And look, what this is when a professional trader somewhere in the world buys a time spread in like large size, it pops up on my screen here live real time literally to the millisecond. You can see what time this happened. This is Eastern time, 2:10 and 45.404 seconds. 2:10:45 and 404 milliseconds. So that was about 20 minutes ago. This is in a stock called CAL. And what they did is they bought the November 32 and a half, or excuse me, the August 24th, November. I'm sorry, I'm saying this wrong. August, November 32 and a half call time spread. They paid $1.70 for it. Now, this is a directional time spread, which is very interesting. The regular August expiration is 10 days from now. So right now, CAL stock is at 36.76. They're looking for it to fall to 32 and a half, which is about 12%. Interesting. They're paying $1.70 for it. Also interesting. Now, it's weird that they didn't look at, well, no, I guess it's not weird. They didn't look at the September options, and I can tell you why. Because when it comes to time spreads, and Barry, if you're in Time Spread Genius as well, you'd know about this. We always look at the implied volatility of the options. Now, they're doing this on the call side, not the put side, which is also a little bit peculiar because why would you trade the in the monies? And basically, we can back out some information here. The stock was at 36.76. So the August calls that were purchased at 435, we go 36.76 minus, which is the stock price right there, minus the strike price, 32.5 equals $4.26. So they sold these for 9 cents over parity. These they bought for whatever over parity. Why would they sell this for 9 cents over parity? I don't like this one. This could be a roll. Now here in love, I love love. And so this is kind of a better one. They did this in 2 trades. Now, I mean, take a gander at this thing. They did about 3,600 contracts. So 3,600 times 80 cents times 100. This trader here who made this pair of trades invested $288,000. This is over $250,000 trade that they're putting on. That's pretty freaking amazing. Now, I traded that one earlier. And hey, by the way, just so I know, you guys like me talking about time spreads here? You like kind of seeing my like proprietary system on how I trade it? Give me a yes or a no. Give me a yes if you like me kind of sharing my secret sauce here. If not, I'll stop. Yes, no, maybe so. Yeah. We can talk about just the, yeah, okay, thought so. I know there's a little bit of a delay here. I was like, what? Really? Okay, fine. I'll talk about something dumb like directional trades. Okay. So look, with this trade, and this one I traded it. What they were doing here is buying the September 27th 25 puts, selling the August 23rd 25 puts at 80 cents, paying a net of 80 cents. Now, this one is a pretty neutral trade. It's slightly bearish, but it's pretty neutral. It's like it has, to be perfect, it would be nice if it fell 2%, but no big deal. So I modeled this puppy out earlier, and it looks kind of sort of something like this. And this trade, I put it on. The reason why I created this time spread genius and stuff is because I want the best trade ideas. Who has the best trade ideas? Professional traders have the best trade ideas. I want to see their trades when they pop up. Make sense? So what I do here is, what I did here is I set the slices, and these are the break evens 10 days from now when this expires, August 23rd. That's when the short option expires. So if it goes lower than 24.40 or higher than 25.70, we'll say, that's where the trade runs into trouble. So, oops. So 24.40 is about here. This was sort of that panic selling. And 25.70 is like here. Wait, 25.70? Yeah, 25.70. Oops, I keep doing that. 25.70 is like here. So, I mean, it's got to stay in a little bit of a tight range. It's a little bit bearish. When I put this trade on, love was, no, I guess it was right around here. It's a slightly bearish trade. I mean, the technical risk is that it fills this gap. But here's what's great about the trade. Well, I mean, really, what's great about the trade is that this is a, what do we got? $1.60. Oh, here. Sometimes the prices bounce around, but we've got about a $1.50 range. It's about an 8% range, skewed to the downside. which a lot of these credit spreads that I've been seeing are skewed to the downside. Not all of them. Sometimes we get some bullish ones. But we just got a bullish one pop up. So anyway, that's a trade that popped up here on my credit spread genius, or I mean my time spread genius that I like a lot. In fact, it's actually a little bit better now than it was earlier. Better volatility setup. You can buy a 37.5 volatility on these puts and sell a 38.72 volatility on these puts. So actually right now, I think you should be able to buy them at an even better price than I bought them earlier. Where did I buy them? Oh no, I bought them at 79 cents. Okay. So there's a really nice trade. Okay. I just had another one pop up on Time Spread Genius. BHP, and this is a bullish one. BHP, I mean, it literally just happened. Stock trading at 53.70. It's the 65 strike call. Oh, this, my friends, is a roll. See, that was interesting. So why did I create Time Spread Genius? I created Time Spread Genius because I want to see the best time spread trades. Created Credit Spread Genius because I want to see the best credit spread trades. And after creating this, like I get this data sent directly from the CBOE. After creating this, I realized that there's actually more information that's divulged from traders than just what their good trades are. I can actually, like, it was a surprise to me. I didn't intend it for this purpose, but it ended up working for this purpose. So this trade right here, why would you, okay, so buying the June of next year, 65 calls, that's like 10 months away, and selling these August 65 calls that expire like next week or whatever at a penny. Why would you sell those calls at a penny? It doesn't make sense. This is not a time spread, because how do you make money on a time spread? You make money on a time spread by the short option decreasing in value. This option only has a penny left in it. So the logical question is, why would anybody trade this? Well, here's why. This is a bullish trade. This is a roll by someone who wants to continue his or her bullish trade through the next 10 months. They had this trade on and it didn't work out. They now realize they need more time. So they're going to sell this for a penny and buy these at $1.25. Now we can break that down further, and I'm going to do that for you right now. Why would they sell it at a penny? What's the difference? It's a penny. Why don't you just throw it away? Well, you know why? Because these are professional traders. This is 876 contracts. That is $876 back in their pocket that they would otherwise flush down the toilet. If you don't care about $876, my PO box is 11-7. No, you don't have to send me any money, but point taken, I think, right? Like this, that's what professional traders do. They watch every single penny. Now, so this is interesting. Now, the June 65 calls at $1.25. Shit, what was that again? BHP. Charts. We need a longer time horizon here. So they're looking for this to return back up to the 69 level here. It's choppy because it's an ADR. And, we always have to look up on Barron's what these guys do, I guess, right? There's sometimes when I do trade on purely technical analysis and don't care what the company does. But if I'm going to be holding it for 10 months, potentially, I got to know. And it's apparently a big secret. Oh, copper stocks. Oh, copper stocks. That's interesting. So copper, one of the reasons why copper has been um, a talked about thing is to roll out a very, very big aggressive project for the infrastructure for electric cars. So maybe it's an election bet. Um, it's hard. I mean, traditionally, electric vehicles you would think are more aligned with the Liberal Party values, although the conservative candidate is realigned with somebody who makes electric cars. So I don't know. I don't know what that bet is. Maybe that is the bet. Maybe the bet is I need to hold this through the election and have enough time for something to play out. And whoever wins is going to have to build out more infrastructure. I don't know. It's a lot easier to read charts than it is to figure out what players in the market are thinking. But what I do know is that there was very, very solid support here until we had this market sell off. And we're not retracing back as strongly as we have been in some other stocks. Interesting. Now, from a pure just options standpoint, we're looking at these 311-day options. $65 strike calls paying $1.25. That's a 25, about a 26 volatility, which gives me some sort of indication of are the options cheap or expensive. And ironically, there's very low volatility right now in BHP. This is about almost the lowest in the past 6 months. A more normal level is around 26, which is the volatility level that this person's buying. We've got fairly wide markets. So this person probably wants to keep this for a while. But, 311 days out, we're always going to have fairly wide markets. Back, if we're looking at like the 38-day market width, no, it's not really a lot better. I don't know. I just hate trading these that have such limited volatility. Oh, you know what? I just thought of something. Later on this evening and tomorrow evening, I actually have a webinar, well, more than a webinar, like a live training on Time Spread Genius. And if you're interested in watching that, you can sign up at markettaker.com/reg, markettaker.com/reg, as in like register. I'm going to type that in the box here, markettaker.com/reg, because, I like to share as much as oh, thanks, David. I like to share as much as I can, but, like David makes it fair for everybody and gives everybody an hour. And, once you get to like 59 minutes in, we got to call it. And I just can't explain everything that I need to here today. Plus, some folks want to look at other trades besides time spreads. So yeah, if you're interested in learning more about how Time Spread Genius works and maybe even how to get signed up for it, go to markettaker.com/reg, and I will see you this evening or tomorrow evening. If you register for the one this evening, registers you for today and tomorrow. Okay. Do we have any more? No more Time Spread Genius ones popping up. I mean, we could see if there's anything interesting on Credit Spread Genius. So this one, let's work backwards to get the fresher trades, because the market really rallied. It's not a crazy rally. 1.5% is not like, a career move or anything here, but it's kind of a lot. It's definitely outsized. So let's work backward for fresher trades. So this one with PayPal at 65.56. This is someone selling the 65 puts and buying the 61 puts. So these puts are less than 1% out of the money. It's a pretty aggressively bullish trade. Why would we do this? Well, let's take a look and see if it makes sense. First thing we've got to start with is the chart. Start with the chart. Start with the chart. So this is a very different chart than we've been seeing lately. And it's because their earnings were a lot better. I mean, they're like 20-some% better than expected. You have trouble understanding if your profit was spreads? Well, Barry, each of our Genius things, it comes with the accelerator videos and the boot camp. So if you haven't watched them yet, definitely watch them. There's a lot of amazing answers in there. Definitely watch that. But with credit spreads, I mean, the concept is very simple. With credit spreads, look, if you sell a spread that expires, this is 10 days from now, it expires on, no, this is, wait a minute, when's regular August expiration? Oh, that's Friday. Okay, so these expire Friday. If you sell options that expire Friday and they're out of the money at the end of the day Friday, what happens to them? And I'm asking you, I want you to answer. While you're doing that, but definitely watch the accelerator videos. I spend a long time thinking those through and creating them to make your trading really super simple. You'll have a very much better time trading if you watch those. So yeah, PayPal sold off here. We had like lower highs, lower lows, definition of a downtrend, and then really blew the doors off earnings, but had a bunch of volatility with the rest of the market since then. This is the panic sell-off. This is the recovery. So this is kind of an interesting trade. It's obviously a very bullish trade because this trader is selling like almost right at the money calls or puts rather, and just buying the 61 puts as basically an insurance policy. So why doesn't this person just buy calls? Well, because look, the historical volatility, which it says here, it's 46.6. Let's just call it 47. But that takes into account this big, huge gap. And this big move, which could repeat itself, but this huge gap was an earnings gap. So historical volatility is really kind of more like 30%. So if I can sell options at or above a 30% implied volatility, I'm selling them for an edge. So this person is selling this and buying this. These are very tight markets, which is wonderful. I mean, the only thing with this is it's a very aggressive trade. What I like to do on these is I like to give a little bit more what I call wiggle room. I mean, right now we're 27 cents away from that one put being in the money. So what I like to do is, okay, let's sell them the 65 strike puts. What if I sold the 63 strike puts? You know, I got more room. What if I sold the 62 strike puts? Oh, now I've got a great deal of support helping me out. I like selling the 62 strike puts a lot better, but I can't really get too much for them. I would have to go out to the 17-day ones. So I don't know. I've got a little bit of skepticism there. I think that one's a little bit too aggressive for me. If anyone has a trade, I'm thinking I got enough time to look at one more. Speak now or forever hold your peas. Lily. Thank you, Bonnie. Eli Lilly. So we all know what they do. Eli Lilly just had earnings that were much, much better than expected. Much, much better. And we got a pretty big drop. Now, interestingly, I said drop, I meant pop. We got a pretty good pop. Interestingly, it gapped up way higher, but closed a little bit lower. It gapped up above the 50-day moving average, but closed below it. So what happens with this is usually there's something said in the conference call that spooks people a little bit. And a lot of times we get a lot of follow through from that. However, the next day was up and we're kind of living above the 200-day moving average now, living above this support level at 862. Can maybe call a support level here 885. And there's kind of nothing but blue sky ahead above that. The all-time high was here back in the week of July 15th. We got a gap to fill down here, but you know, there's a lot of wind in the sails. We do have a lot of volatility. So if we get a sell-off, we could cross back below the blue Rubicon here and fill this gap. It's really, you know, it's a challenge. Let's see if there's anything from a time spread perspective. We don't get a massive amount of edge by selling that much higher of a volatility. We do a little bit in the 3-day ones. What did we say the historical volatility was here? If we get rid of this day, it's kind of more like around 40 or something. So, I mean, we can buy some pretty cheap volatility in the back, but the front volatility we're selling is kind of fair, which is okay. How do we like maybe the, just going to model this out real quick, and I know I got to go. We buy the 10-day 905 puts, sell the 3-day 905 puts. You would be, well, here, let's duplicate the order real quick. Probably have to pay about $650. Lily it's more liquid than others, but it's not as liquid as you want it to be sometimes. So if we did this and we look at the break evens at expiration, to lose on this, it'd have to go down to 882 or up to 930. So down to 8. 82. Or up to 9:30 over the next 3 days. It's not a bad trade right there. I'm too out of time to put it on right now. I'm going to further analyze it, weigh my decisions on it, and maybe trade it for myself. And so if you have any more interest in time spreads, I've got a really, really great training this evening and tomorrow evening. You should definitely attend. It's free, and there's going to be a lot of great stuff. Anyway, I hope that helped. I was glad to share